Welcome back, everybody, to episode 2 of the newly named, by popular opinion, the Market Pace. So today is February 24th, 2020, and the SP500 closed at 3225.89 points. Change from the last episode is 3.92%, negative 3.92%, and most of that is from just today, where the S&P 500 dropped negative 3.35%. It was a rough day, for sure. As a result of a lot of things that have changed in the last couple of weeks since the last video, my market status has changed to from goodish to worrisome and uncertain. As a result, I am hedged in a what's known as a delta neutral position. So stocks can go up and my account would mostly stay the same. Stocks can go down and my account would mostly stay the same. That's what delta neutral means. No matter what move happens, my account for the most part is neutral. The major things I am seeing is that the Fed wants inflation, but they don't want to cut rates. And I'm also seeing that the US dollar is very strong and global currencies are weak. And if they don't want to cut rates to lower the value of the dollar in order to spur inflation, and global currencies don't rise in value to also make the dollar weaker and spur inflation, none of those factors really work together in order to cause inflation. So we're kind of in a tough spot for the Fed and for markets to continue going up. And also the coronavirus is still a factor in this market that is causing many global currencies to weaken, as well as keeping the dollar strong. So that is kind of playing into this sort of a scenario that I've just displayed. I'm also going to talk a quick minute about Bitcoin. I still think that trade from the first episode is still good. However, we will probably see a bit of a decline in the coming weeks from it. And I also do want to talk about a new top trade, which would be bonds, specifically the symbol TLT or TMF if you want a 3 times leveraged return. Of course, that does come with higher risk, so be sure your portfolio could withstand that. I'm personally undecided on which side I want to take, though. I'll talk about that towards the end. But first and foremost, disclosure. I am, of course, not a financial advisor, and this is not financial advice in this video. True financial advice takes into account your income, your financial goals, your retirement, your age, and a bunch of other factors that I, of course, do not have for the people watching this. So it's not financial advice. What this is simply me sharing information that is publicly available about markets and news. It's also me sharing my opinions and actions that I am taking as a result of those factors. And last, I likely do have or am planning on opening positions that are mentioned in this video. So on to the good stuff. So the major point of this video is why are markets worrisome for me? And the biggest thing is global currencies affecting the interest rates. So I want to start with global currencies, mainly the euro and the Chinese dollar. So not too long ago, maybe a week or two, a few weeks ago, Britain had left the European Union. And since then, I believe you can see this decline that's been going on for about February, a little bit before, where the euro has been dropping pretty much straight down. That basically is a result of the value that Britain provided to the euro that has disappeared basically overnight. So as a result, the demand for the euro has just lost one of the biggest producing nations of the euro. In addition to that, many nations in Europe are still lowering rates and providing stimulus to their countries. So this again is increasing supply of that currency. So higher supply, lower demand is a lower value for that anything. In this case, the euro, dollar, the currency. And next, China. This is the CNY over USD market. Of course, the coronavirus the epicenter is in China, and the Chinese government has provided lots of money to try to counter its effects on their production, which has, as I said in the last video, been really cut down to zero for a few weeks. So again, in this case, the demand hasn't really changed, but supply has increased, and this is causing a reduction in their value of their dollar, their currency. As again, you can see from around here that the currency has, when coronavirus hit around here, that the currency has dropped. And will likely continue to drop or until further notice when coronavirus starts to recede. Which hopefully will happen in the coming weeks, coming months as temperatures rise and the coronavirus is very extremely flu-like. So as the flu is strong in the winters, the coronavirus will probably be strong in the winter months. So that should be starting to go away soon. It should help that get under control, but that remains to be seen, of course. So the main meat and potatoes here is the U.S. dollar. The U.S. dollar has hit new highs for the last several years, and this is really bad for what the Federal Reserve wants. The Federal Reserve in the last several meetings has said they want inflation to be 2%, and over the last couple of years, they still have yet to really hit that 2% target. Having a high dollar value means that every $1 can buy more actual goods. So if you want a loaf of bread to be 2% more every year, cost 2% more, having every dollar buy more loaves of bread in volume is not what will make that happen. You want every dollar to be cheaper, every dollar to buy less value, every dollar to buy less bread in order to have it cost 2% more dollars. So a high dollar value like we are seeing is bad. And again, since this coronavirus hit, the dollar has just skyrocketed. I mean, it went straight up from being somewhere in this middle ground here, and even actually starting to look like it was about to kind of drop and keeping this downward trend it had going from October. New high was lower. This new high was about the same. Then a new high was lower, lower, and then it's reversed, and now it's going higher, which is the exact opposite of what the Federal Reserve wants to be seeing to get inflation. So what I think this is causing is, one, some turmoil in the markets because the Federal Reserve does not want to cut rates. They've cut rates several times in the last year, and they've also provided plenty of stimulus, as I talked about in the last video with the repo markets, and they've already done QE 3 times, quantitative easing 3 times from the last financial crisis, and they kind of view quantitative easing as a nuclear option that is going to be reserved for true financial crises, which we are definitely not in right now. Jobs numbers are strong, and production is strong. The dollar, of course, here is strong. So we're not in a financial crisis. They don't want QE. They don't want quantitative easing. They also don't want to cut rates because they just said they've already done it a bunch of times. They want to see that effect really come into play, which, as it seems, isn't happening. So to recap, we have a strong dollar, global currencies are weak, the Fed wants inflation, but they don't want to cut interest rates to lower the value of the dollar. And a high dollar is not good for inflation. All of these really do not go well together. So that brings me to my next chart. The S&P 500 just dropped off a cliff. So once all those have started to show their hands there and show their effects on the markets, we just took a 3% dive today. I'm thinking this could change as we go into the next Federal Reserve meeting, which happens mid-March. We'll see what they say. I don't think they're going to change their stance on rate cuts, at least not that quickly. And what they do say is probably not going to be strong enough to really bring the markets back, which will probably cause the drop a little further. So for me to talk about where I see these targets heading, as far as the S&P 500 value goes, I got to start talking a little technical analysis. So that's where all these lines here come in. First thing I want to talk about is these two red lines. This is the channel that we've been trading in since the phase one trade deal, which caused a nice 10 to 15% surge and new highs that happened just a few days ago. We just broke out of that today. Typically, when we break out of these higher upward trends, we continue going that way, and we'll do a mean reversion back to a previous channel, which is these two orange lines. These two orange lines are the main channel we've had for some time now. This, I think, goes back to pretty much January, I believe, actually. So the highs from then kind of line up all the way up here, and all these lows line up all the way here. And I think we're going to end up going back into that. This channel is about 3,100 to 2,900. And we could definitely see us getting into this channel by that March 17th point when the new Federal Reserve, or the next Federal Reserve meeting happens. And it also does line up with support levels. The next major support level I see is here, about 3,100, 3,125, I believe it was. I did mention in the last video. And also this 3,250, 3,225 level that we're at right now. So we did just break under 3,250. We held under 3,250. If we push past 3,225, the next major stop is about 3,100, which gets us into this channel. So that's what I'm seeing as the next kind of few weeks to a month, that we're very likely to go into this channel. However, I just don't think it's likely enough to go full bearish into the market, because as I said before, we're not near a financial crisis, we're not near a recession, we're just broke out of the major trend we've had here for over a year, broke out of it upwards, and now we're just doing a mean reversion back to kind of where we should be for a long, steady growth of the economy, which, every year the economy does grow roughly 8%. That's just a common average for the S&P 500. And this last year, we got about 20 to 30%, which is, of course, oversized. So it means a pullback is due. And right now, I believe we're having that pullback. That pullback is only good for about 10%, maybe even 20 at most. And I don't think that's enough of a risk reward to actually go full bearish and start leveraging yourself to make money on falling prices. So what I am doing is I hedged my accounts. I did that by using this one stock symbol called SPXU. It provides 3 times the leverage of the S&P 500. So what I would do is sell whatever portion of your portfolio that you'd want, sell 25% of your portfolio that you want to keep in money. That 25% you put into this SPXU position, which would hedge the other 75% that is long and making money as that stock goes up, as the S&P 500 goes up. So if the S&P 500 drops 1%, that SPXU position went up 3%, which counters the 3 times as much on the other side. So basically, you end up being delta neutral. That 1% drop ends up doing 0% damage to your portfolio. If stocks were to go up, you end up getting 0% benefit to your portfolio. And you kind of just sit there. All the while, though, you do get the dividends from the 75% of your portfolio that is still in something like the S&P 500 or the SPY, SPY. So that is kind of where I'm at for the next few weeks until we hear something from the Federal Reserve in mid-March. And depending on what the market reacts to that and what sort of support levels it hits or breaks through. And I'll probably do another video at that point. So yeah, probably another 2 weeks. You'll probably see episode 3. And I'll tell you what the Fed's been doing. And I think that about does it for what I want to talk about the S&P 500. So yeah, so top trades. I'm sticking with the Bitcoin trade. I'm expecting it to go a little lower though in the short term, maybe even break past 9,000 to even 8,500. I wouldn't expect too much more lower than that. Let's see. After 8,500, it'll probably revert back to going into a bullish pattern and go upwards, like I said, till about June when we see the Bitcoin mining reward halving. as I talked about in the last video. So that Bitcoin trade is still alive. I did mention the bond trade. I would not get into that bond trade right away. I would wait for a dip in bonds over the next week or two to find a good entrance. Otherwise, I might just let that bond trade just, fly by. I'm not going to try to chase it. It's not, bonds aren't the biggest movers. A big move in a bond ETF is 5–10%. So it's not a big target to hit. I like to aim for big targets on my trades, not small targets. This way you're more likely to hit something that's profitable. So I'm waiting for a pullback on that, and I will keep up to date with both the Bitcoin trade and the bond trade. If I decide to not call them quits or say that they're successful, I'll post in my Facebook and Instagram stories that this Bitcoin trade's over as a loser, or Bitcoin trade's over and it was a winner. I'm still expecting to be a winner over the course of June, so don't expect something from that too soon. And I'll keep up to date with the bonds over the next week or two. If we find a nice entrance, I'll post a trade in either the TLT or that triple leveraged 20-year Treasury bond ETF as well, depending on how good of an entry point it looks like. So keep up to date with those. And that about finishes everything I got. Do you want to leave you with a little quote here? So money is just something you need in case you do not die tomorrow. Let this, I think it's supposed to be a reminder, but this quote might be wrong. For you not to obsess over profits and losses, and in whatever you do, strive for enjoyment, focus, contentment, humility, openness. Paradoxically, and as an unintended consequence, your trading performance will improve significantly. I did like this quote for today since we did see a huge drop that does come with a lot of emotions, negative emotions specifically for your portfolio. But you got to remember that as long as you still have some money, you still keep yourself protected and have that money able to work for you in the future when times are better or times are more clear, you can still perform well in the stock market. One bad day will not destroy everything. Now, this is a quote by Ivan Bayaji. He is a trader for a living, and he runs a blog on trading composure. I did watch a couple of his videos. He seems to have a good view of everything. So yeah, I chose this quote to leave y'all with. It's not the end of the world just having one bad day. Just keep that in mind. And other than that, good luck out there and happy trading.